Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, October 1st, 2024. It's 12:14 p.m. Eastern Time. I'm starting the video, and I'm going to keep it focused just on the equity markets for now, although I will start out and just throw in XLU since I had a question on that. XLU was posted here initially as a swing trade idea on the 20th, so a little less than 2 weeks ago. A week and a half or so ago, and it was added in anticipation right here of a breakdown of this bearish rising wedge pattern with an alternative entry or an add-on to come on a solid break below the wedge and the intersecting 78-ish support right there. So somebody asked for an update. I'm going to give you that real quick. I did give a suggested stop of 81.50. Above 81.50, we hit 81.54 today. So that was obviously for that entry. The second entry hasn't come, so I'm going to leave it on as an active trade. I'm going to share my thoughts because we still don't have the alternative entry or add-on, which is now you have the trend line up here higher. Right here, we were right here that day, and so the trend line is the first support level to go. Should do the trick, in my opinion. This is should seal the deal, that 78-ish or 78.10-ish price support. And I'm going to rifle through real quick my thoughts. So nothing's changed on my outlook. I still believe a breakdown is imminent. Imminent is relative to the time frame you're looking at. This is a daily chart. Here's a rising wedge. It's been, like I said, we've had 1, 2, 3, 4. It's been about a week and a half of trading. So not much of a long period of time. You still have what seems to be indicative of a potential blow-off top here. And more importantly is, other than the fact we haven't broken down below the trend line yet, and that's still the safe, higher probability trade, we have a mixed bag. Some of these stocks I'm just going to rifle through, as I often do. I have the watch list to the right there, and they're sorted by market cap. NEE, which is Next Era Energy, is the largest one in XLU. It's a 173, almost $174 billion company, and it has a beautiful bearish rising wedge pattern, very well defined, clean, negative divergence. So the story is this, and I'm just going to rifle through these. Some of these have already broken down. The majority yet hadn't. It's similar to that QQQ video I did this morning with the top components, where some had broken down, some hadn't, but then after the opening bell, we had more of them break down today. Apple and some others. I'll get to that in 1 second. So this is what and if you set a price alert on these, same thing. Collectively, when the majority break down, that should do the trick. So this one, SO, the second largest, still riding the uptrend line. Textbook bearish rising wedge pattern breakdown still appears imminent. Duke has broken down. There's the wedge, there's the divergent high, there's the breakdown, and it's kind of moving sideways since. CEG, Constellation Energy, right on the close to the trend line there. AEP, breakdown, kickback rally. So what happens when you break down below an uptrend like this, uptrend line? Typically one of two things. Sometimes you never look back. There's always going to be reactions along the way once you make a trend change. You're not going to go from here to here without zigzagging down. Now, what happens is sometimes when you break down, especially if the majority of the stocks in the sector haven't, like I just showed you, the top, a few are still right on or just above trendline support. So what happens then, those guys will break down and have a snapback rally, sometimes backtest the wedge, those that have already broken down. So I'm just kind of showing you collectively, and I'm just clicking on that list. So I'm cycling through those again in order of market cap. And these all appear, again, like I said, textbook bearish rising wedge patterns that appear to be, will appear to break down any day now. PCG, Pacific Gas and Electric, Dominion Energy, boom, breakdown, back test, and so you get the point. And then you have a little minor support level. That's not what I wanted. I'm trying to do just a horizontal line right there. And so that's it. So as you can see, a little less than half have already broken down, and those that haven't are right on the line and close to it. And there's another breakdown, XEL, another breakdown, EIX. So a lot of the second and third tiers, you notice as I go down the list more and more, I don't have them all marked up, obviously. You don't need to do that. You see quite a few have broken down. And so you just need those final few big ones that most likely have a higher weighting on the ETF to break down. So if you set price alerts on NEE, SO in DUK, Duke Energy, you'll probably see that. And I imagine Duke Energy is going to have some expenses with the big hurricane that just beat up the Carolinas and stuff. So, all right, that's that update. Let me get to update on the markets. Let's start out with stocks. Because I give you an update, and that trade hit the first target today. I told you reactions likely. Went on to say that I, told you this morning, I'm doing that video, started that in pre-market, got it out to you right after the open, that I started noticing, across the board, clearly bearish imminent breakdowns again on the top components of QQQ, many of which since broke down, but then I went on to tell you that I also reversed those, covered those shorts in reverse because you had multiple things, including SOX right there hitting T1. And I'm not looking for a lot. And I'll be honest with you. Well, I'll tell you, I'll probably, there's a chance before this video is over, I'll even reverse back. But yeah, here it is. I'm just looking for a minor reaction. I've pretty much got it already. Let me just tell you on SOX. So far, it's bounced about 1.2%. And that's it. We could go more, certainly could go more, but let me get to everything collectively. And so there's the breakdown. See, we're fresh off the breakdown, so I'm not going to try to get too greedy. I'd rather get back in to those shorts earlier than later and miss a turn and a favorable entry. I'll go back to QQQ. I was covering that this morning. We had the 60-minute chart, a couple trend lines there. And this is the support level in that update I gave you on SOX, where I told you I had QQQ at support and SPY, a lot of things. Beautiful. That's at 477.72. You remember it's been a level I've had on this 60-minute chart for a while. Very significant level, in my opinion. And we back tested it today. So I would have been surprised if the buyers didn't step in there. $1 million question, how high do they go? I'd say I could easily see us going up here, 485.03. Wouldn't be surprised if the sellers came in and stepped in early. There's a potential downtrend line. So there's kind of, let's just say from where we are now up to there, that's kind of my expected bounce target zone. And again, I've explained, to me, it's not worth milking out. What are we talking now? Another 0.5% or a little bit more and miss what may be a move down, and we could close down 3% today because we had some pretty good sell signals. Let me talk on those. Apple. So this morning we were in this bearish rising wedge. Boom, right out of the gate. Hard, that's what you want to see. That is a textbook sell signal, big red impulsive bearish candle. Bearish candle, obviously. Breakdown, but it confirms. And then where do we stop? This level I've had here for a while, 224.64. I believe it was on the video I did this morning. It's the top of that gap. There's the bottom of the gap right there. I don't have a line on the bottom of the gap. I can put it for you. It's where we closed that previous day down there. And gaps, once entered, are often backfilled. So you've got some support in the middle of that gap area too. But either way, what they're doing, this is where, a reaction I define as one of two things. If you're going up into a resistance level, a reaction will be a pullback. So I define it as one of two things: either a reversal, so when you're going down, it'll be a bounce, or a reaction in time. So you can have a reaction in time where you just trade on that level for a little while, or in price, or sometimes a little of both, right? And so far, this is more of a reaction in time, which is the more bearish of the two. You can see these are 60-minute candles. So Apple hit that level, and it's just been like a sack of potatoes. So when I, talking about reactions, I use two analogies. You can drop a golf ball, hold a golf ball in one hand when you're standing on a concrete or a tile floor, drop a golf ball in one hand and a hacky sack in the other. The golf ball is going to bounce, and it's going to bounce even more than, say, a tennis ball. The hacky sack will just hit the ground and sit there. And that's kind of that's what we're seeing so far. And I don't expect a whole lot of bounce out of this. So, in fact, I just fired it off. All right, so that's it. I told you I'd start the video, and I'm not looking for too much. So I'm going to go home back to short, which I just did, and ride it out for the rest of the video. And most likely into and after the close today. We'll see. I don't expect much of a reaction here. We got a reaction already, and I didn't expect much, as I said, so that's it. All right, Apple. So there it is. again, and remember, guys, that if you're looking at trying to quantify, and I know sometimes I probably shouldn't even talk about active trading, like this hyperactive stuff, inter-day trades, little gaming 1% bounces, sometimes even less. It's well worth it if you trade futures. I don't have to tell you. If you trade NQ, you know how much even just a single contract, what a 0.5% or 1 percentage point on a single contract will get. And then if you're trading multiple contracts, it's enough to buy you a few PBJs, right? If you can game a 1-2% bounce on, with 10 contracts NQ or 20 or 5 or 1 or whatever your number is. And you might trade if you don't, you like futures, but you want to keep the position size smaller because your account size, MNQ or the, what do they call them? The micros are many smaller. The NQs are the the regular futures we trade, and then they have for you ES traders that trade the S&P 500. Just put the letter M in front. All it does is brings down the multiplier. I think the multiplier in NQs is 20, which is you take the index value times 20. That's your multiplier or leverage factor, and then you just have a smaller multiplier on the what do they call them? Micros or minis, whatever is with the M in front. And again, and I say that because it's the same charts. When I give you the levels of NQ that I'm trading, and I'll go over those in this video, you can use those same charts and the same price levels. The only difference is because those smaller, the mini contracts have a lower multiplier or leverage factor, but they trade off the same price level. So, and here's what I was going at. So these trends, like I've showed you, last divergent high, or the previous second to last, it was a 17% drop. The last divergent high was a 9% drop. So far we've only had a 3% drop. And so based on that, and back here we had a divergent high, we had a 18% drop. So you take the average there, and that's been in an uptrend. So let's just, for kicks and giggles, say this uptrend continues. Market's going to new highs. It's going to blow past my market top ranges. Even then, you're looking at average of double-digit drops each time you have these divergent highs. So therefore, I think that's the point I'm trying to impress. I got a little bit on the bounce. That's it. But this thing is just getting going. You have missiles, about to fly in the Middle East. You already have missiles flying, but, obviously Israel now is, according to U.S. intelligence, they believe an attack. Iran's planning to launch another full-scale attack, missile attack like they did last time. And I have to guess, just to digress here for a second, if our intelligence is right, and there is another attack on Israel directly from Iran. Last time it was over 300 ballistic missiles, cruise missiles, and drones. The U.S., Israel, and some of the other allies shot down nearly all of them. It was a resounding success for the missile defense system, but I'm going to guess that Iran, who must have ate a lot of crow and spent a lot of money on those missiles, aren't going to make the same mistakes. If they're going to do something that's going to be a little, I would have to imagine, a little bit, mix it up a little bit. I don't know if they have, Russia's obviously probably going to help them out here, whether it's supplying missiles, radar jamming and stuff. So, and I hate to say it, but I'm going to have to imagine they're not going to want to look foolish again. So if it does happen, could have more significant consequences this time around. And where I'm going, guys, I don't think, and I've been saying this for a while, there's a lot of this risk, both geopolitical, which we're talking about now, Middle East, but even economic risk is not priced into this market. That is evident by the minuscule razor-tight credit spreads, which, again, I think it will go down at some point over the next year as one of the biggest mispricings and one of the biggest opportunities when those credit spreads blow out. And, best case scenario, everything hums along and the Fed continues to engineer the perfect landing. They stick the landing, economic growth, no inflation, full employment continues, blah, blah, blah. If you believe in the Easter Bunny and Santa Claus, and hey, maybe that's going to happen. Maybe those things exist. The signs are it's most likely not going to, and therefore, you're going to see those credit spreads blow out, and there'll be opportunities in both the stock market and the fixed income markets. But all right, back to that. Let's just rifle through these. That last video earlier today was probably more long-winded than it should have been. Microsoft still has that potential divergent low, although it's taken out now on the RSI. You've now made a new low, and it was the only one, and still is, with positive divergence. Even then, they just actually made a lower low there, probably taken it out. But it's at support, so that's why the market's kind of hit that floor today when I got that post out to you on stocks. And so or if you're new to this, you haven't followed me for a while, or if you have and you haven't picked up on it, it's the farthest thing in the world from mere coincidence that when I have, major key sectors like the semiconductors hit support, at the very same time you have completely unrelated or largely unrelated companies like Apple and Tesla. They're not chip makers. Let's say pick another tech company that doesn't make chips. I think Apple might have their own chips on, but you know what I'm getting at. They're not semiconductor companies, but all this stuff happened on August 5th. We had everything, just about everything, hitting key support levels. Every sector, most indexes, a lot of key stocks. Not literally everything, but so many things it was impossible to ignore. How many things at the same time, and that happens a lot. So the point I'm trying to make, today's lows, stocks hit its price target. Apple hit that gap. Again, levels that were on the chart ahead of time. If you go back, reference the video, not just made up after hindsight levels. NVIDIA just kissed that. Again, these are old lines created back in June 24th right there. That's the 116.35 level. Hit it, and little bounce so far in NVIDIA. But it's what's happening now is the bearish case is firmed up. We had a breakdown the other day. We had a back test and a pretty impulsive rejection. And so that's it. So we're just waiting for the next leg down, which, keep it very simple right here at this point in the video, should come on a solid break below today's lows. Will most likely do the trick to open the door, whether that comes today or tomorrow or later this week. Alphabet, that one was rocking in pre-market. As I mentioned, you could have shorted it right there because you were at resistance. And if you did, I said a little tight stop because you're at resistance. It shouldn't go up much. Then, nothing huge, but you made here. I'll have to go to 1 minute chart. Yeah, and then you would have covered when SOX and QQQ and everything else, as I mentioned when I got that SOX. You made a quick 3%. And then that's that whole velocity thing. I make a lot of terms up in trading, my own little vocabulary. And velocity is a term I made up years ago that just let's say SOX, for example, you hit the 3% if you booked profits day. Again, that was one of the shallowest targets I've ever had for the semis. But let's just say you booked a profit because that's your strategy. You want to take the quick, high probability trades. Here, let's show you what I'm talking about. You go to resources, frequently asked questions, trading related questions right here. Why do some trades list multiple price targets? And I go on and on about it, and it's just, makes sense. But basically, you obviously have the highest chance or probability of reaching T1 than you do some of the higher targets. Now, there's more profit potential, but if you want to just hit and run and take all these quick, high probability targets. And so let's say with SOX, you make 3%, book your profits, get out. And let's say you just sit back, you wait patiently, like you're waiting for your pitch. As a batter will wait for his pitch, whether it's, high and tight or low on the outside. Everyone has their own pitch. Everyone has their own setup in trading. You wait for that setup and you do it again. You do it next week and you get another 3%. Well, there's 52 weeks in a year, 4.3 weeks in a month. So you're doing, better than 12% a month. That's, average. That's better than 150% a year, non-compounded, right? So you're blowing the market away if you're doing that. But that's not for everybody. Again, it's just, something to consider. I still think there's going to be more downside to come. And so, again, we had, and just, SOX was a one-day trade. Google was a 1 hour trade to get almost 3% if you short it this morning. All right, Amazon. All right, I covered all these earlier. There's no change to the ones that already broke down. What I wanted to do is the ones that haven't broke down, like Meta, Tesla broke down, that little minor trend line I had there. Broadcom continues to move lower, getting closer to back testing that trend line. Costco, everything else. So far so good. Oh, ASML broke down, breakdown, back test, and it back tested the primary downtrend line as well. So that's the common theme here. A couple things that the bearish, the 60-minute divergences I highlighted this morning in pre-market are starting. They started to play out with pretty much a pretty good bang today. However, so many things hit their first or some of the early support levels / price targets, such as this, a back test of the trend line. This is a breakout and a back test. And although we had a pretty impulsive selling today, can't get too bullish. From if you want to look at this for what it is, it's a breakout of the primary downtrend line and simply a back test. I do expect that most of these will fail. If and when they fail, it's time to get more aggressively short. And it's not just any one of them. It's not just ASML. Collectively, you want to see the majority of those that broke out, especially including but not limited to SOX and QQQ and SPY, taking out those primary downtrend lines they broke out of. Okay, so that's it. Let me show you the futures, as I said I would. NQ. It's my 30-minute, 60-minute charts, meaning 60-minute candlestick. 3 months of trading history. 918 ish is what I've had on this chart for a long time. And again, that's what I was referring to when we hit that today. Slight momentum field overshoot on everything. That's to be expected. It's another term I've made up. When you have a lot of velocity heading down, this is just kind of grinding. When you have support and there's low volatility, you tend to bounce right off that support. When you have waterfall selling down or up, you tend to overshoot the resistance level that's going to cap a rally by a bit and then come back down. Same thing here, and that's what happened right there. And I don't even know if we printed a 60-minute close. No, we didn't. There's another tip that I use that, trading on a 60-minute chart, 60-minute time frame, all that matters is 60-minute candle close. All these were skinny parts. That's the wick or the shadow of the candle, saying that each and every one, we never had a 60-minute close below that line. I haven't touched that line in a while. That's been on that chart. So that's a good example of a reaction in time. It's a thud. It's that hacky sack because there's no buyer sitting. Where are the dip buyers today? They're not. They're MIA. And again, they may step in by this afternoon and ramp this thing up. I don't think so. I'm betting the other way. But just wanted to say that that's the more bullish of the two. It just shows that the demand's starting to dry up right now. All right. Okay, so that was NQ for you ES traders, S&P 500. Again, this is a level that's been on this chart. I've shared this chart with you quite a bit recently. My ES 60-minute chart. ES are the S&P 500 futures. 57.28, almost 57.29 is where I have the line. It was all these reactions here, that reaction there. We had the reaction there, a breakout above those previous highs, and now a back test. So this is again where the buyers stepped in today, or at least the sellers stopped selling. Buyers are a bit MIA. They're a little bit above it now. But to me, it's, again, a reaction I expect to be minor and fleeting, and we may have already seen all of the reaction. That's kind of my bet right now. I'm going to, unless something convinces me otherwise, I will ride these shorts into the close and take them home with me today. And that's pretty much it. Another semi-Intel. I mean, just what a beautiful exit. Was that sold price target 24.66 given to you when we hit this long-term support level? We milked it up for 30%. Hit a high on Friday of 24.66. Exactly where that target was. Like I said, always suggest selling a little bit below there in case they step in early. But either way, it's a perfect tag of the target. And now we're coming back to a level that if you want to recycle back in, then that's where they're probably going to buy at 22, unless the market melts down. And again, same thing. Do you want to put your buy to cover, buy limit order at $22.00? No, you step in and buy it at a little bit above that, 22.20, 22.30. A little bit above it. We may hit 22, we may go down lower, we may keep going. So you buy it a little bit above with a stop somewhat below. Somewhat is relative to where you think it's going. If you think we're going to power on up through here and Israel and Iran are going to sing Kumbaya and and Hamas and everybody, maybe they will. I hope, but and again, that's kind of almost been a sideshow. The market's gotten used to the volatile situation over in the Middle East. I hate to say it, but that's what happens. The market becomes callous to things that don't immediately impact it. So I'm probably talking a little bit too much about that, although CNBC, I'm sure, will cite that reasoning. It was also the economic numbers. Remember today, we had the ISM came in below expectations again. I think it was the 7th month of contraction. If the ISM is under 50, that's contractionary. This is ISM right here. And you can see these shaded areas right here are recessions. Recession there in the early 90s, recession there in the early 2000s. There's the Great Recession, or Great Recession they called it. COVID recession, and the upcoming recession is going to probably be right here. It's simple stuff. You see ISM plunge down to these levels like this, and and go below that 50 level. Again, anything below 50 is contraction. So this is where you typically enter the recessions. And look at we're way down here. There's so many economists smoking stuff that I wish I could get a hold of to feel that good and optimistic. But when you look at these things, now what happens is it was offset by a bullish employment report, JOLTS, the job openings report. Construction spending missed too. That came in below expectation. JOLTS was bullish because more job openings, but these are also the ISM is pretty hard numbers. JOLTS, things like this, especially the government's employment situation with their crazy hypothetical birth-death model, just a big guessing game subject to revisions. And as I've showed you, we're at a level where unemployment has troughed. And historically, with zero exceptions, you've never troughed. I don't have it. I'll pull it up and show you how to do that. Just do a graph. I like macro trends. There's others that you can see. Macrotrends.net. Go to economy. Go to national employment rate. And again, if you're new to the site, I cover this a lot. This is the bull's strongest argument right now that employment's at record lows. I want you to look at every bottom when it troughs right before the recession starts. Do you see it stay at that level ever? No, it V's. This is what it always looks like. So, there's a saying in the stock market for bear markets, it's always darkest just before the dawn. Meaning it looks like, think back March of 2009, it looked like the world was going to come to an end with the stock market having no bottom, and it was just going to keep water falling down. And then one day it just started going up, and it never stopped going up, like that Forrest Gump rain scene where it rained every day, and then one day it just stopped. But this is the turn. This isn't a little blip, and so that's what I'm looking at there. So that all speaks to the longer term stuff, and I probably got off track because right now, as today's video started out this morning, 60-minute charts. I just wanted to update, what's going on, and Intel, wasn't random when it hit that price target. You had negative divergence as well, and that divergence is playing out, and you got a little potential uptrend line there. I'm not crazy about it, but again, there's that re-entry point if you're so interested. I'd just be a little careful now based on what's going on with the market, given that rolling over after that divergent high. And again, most simply, and I'll end the video here, this was last divergent high. You got this. This was the I'm sorry. This was the last one you got that. So, by that metric, you can expect something more than just this so far 3.2% drop based on pretty much everything I covered in the video this morning, as well as the update I just gave you right now. By the way, no change in my outlook on the mining and metals. I'll just update that. Remember, Euro USD and gold is highly correlated. They are highly correlated, I should say. You can do a comparison. I do this all the time, but for those that miss it, you can see they move up and down together. Purple line I just added is gold. A clear, unmistakable, very tight correlation of moving in the same direction. Gold didn't get the memo today. They're giving gold a flight to safety bid because what's going on, or at least what may go on in the Middle East. And you've got gold going up today with the euro plunging. One of the two, there's going to be a mean reversion. The charts indicated this. That's why we shorted gold and silver the other day. We're still profitable there. But this breakdown here most likely is going to have an impact on gold. And remember, I did an update on gold yesterday. It hit that first support zone I added there. Just a reflexive bounce, still coming off the divergent high. Silver still below the trend line as well. And so nothing more than just a reflexive bounce. But it's one of many trades. Put your stop where you want if you're in it. GDX hit that first target yesterday, gave you an opportunity, or second target, I'm sorry, gave you an opportunity to book profits. Nothing goes straight down forever. Everything zigzags. That's how I list multiple targets. You're likely to get a reaction upon the initial tag of each one. And this still maintains the, still is the final target for that trade right now, T4. Okay, let me get the video out to you, and hopefully the turn is in for the day. Yeah, looking good so far. And just need to take out those lows and bring in the next wave of sellers. This has been Randy Finney with Right Side of the Chart. Have a great day.